Okay, so we're back, and we were looking at cost of revenue. How's it gone up? As we said, it's gone up over time pretty steadily. It looks like it's been going up in proportion to our revenue stream. However, if you look at our gross income, our margins have actually increased over time, which means that our cost of revenues are not increasing as quickly as our revenue stream is. So if you look at our gross income margin, we have 69%, 70s, it gets into the 70s, and it's creeping up, and now it's into the 80s. So we've increased our gross margin by over 10% over the last 10 years, which is a very positive sign that we're making efficient use of our capital expenditures that we've made over the years and the equipment that we have at the site. And it also makes sense, given the nature of the business, that they're going to use their capital much more effectively. This is a very capital intensive business. The expenses are very fixed in nature. You hire a couple workers for salary or hourly wage, and you're paying them regardless of whether or not something goes through the machine or not. So the goal is to stuff as much stuff through that machine as you possibly can in the shortest amount of time, and increase your profit margin, because your costs are pretty much fixed, which is an interesting business to be in, and it provides a nice little moat that you have these high capital costs to get into the company or into the industry. So we can see as revenue's gone up, cost of revenue has not gone up as quickly, which is a very nice sign for their business. Also, you can see SG&A has gone down as well as a percentage of revenue. It was at 60% of revenue back in 2002, went down in the 30s and the 40s, and it's slowly creeping down, and now it's around 30%. It's been that way for the last 3 years or so, that they've gotten their SG&A expenses down in proportion to revenue. So they're scaling up the business. The growth rate before should be not a good comparison of the future growth rate, because we're not going to see these fixed costs scaling up as fast as revenue. We should actually see growth rate in our free cash flow higher, and we'll go into that in a bit. We see depreciation here, pretty standard. Doesn't look like they're making any major investments which would change their company. It looks like it's a pretty stable depreciation amount, which means they're using the assets they have, and they're just kind of depreciating them down as they're used. So it doesn't look like there's been much change here in their in the capital that they're depreciating out, and they're really only, the capital that they are bringing in is just to replace the old capital that they've used, which is in particular that Cobalt 60 that they use. Okay, so we look at operating income again. Went from a loss in 2002 and 2004. And it's been climbing ever since. So we've gone from a loss down up to 200,000, 300,000, 600,000, up to 1.1 and 1.4 million. So we've had some nice scaling since 2009 as well. We've more than doubled our net operating income. So that's a positive sign that the company's growing. We're now at 1.5 million over the last 12 months. So operating income has grown. It's also grown as a percentage of revenue. As we said, cost of revenues are down, and SG&A is down as a proportion of revenue. Obviously, our operating income margin is going to be much higher. You can see we've gone, obviously a loss, but we've gone from this 11.6% up to 38% in the trailing 12 months. So that's a good sign too, that we have some growth opportunities. Again, no interest income, tax income. This gets kind of strange, and this is one of the nice things about a smaller company, that you can see these little things that are going on here. They operated at a loss for many years, so they have this net loss carry forward, this tax benefit on their books that they can use to shield themselves against tax expenses. This, we're not going to take this into account going forward, because this is pretty much going to be gone at the end of the year. So we're not really too worried about this, but it's interesting to note that they've been using this tax credit over the last couple years to burn that off, and that's all in the 10K on how that all works. So I would encourage you to read through that if you're interested in how that's going to play out. Alright, we'll go down to cash flow. So as we see here, we have net income and depreciation. There's not a whole lot here, just like any of the other statements. Not a whole lot of big numbers. Obviously, they're a small company, but you can see that they're cash flow positive. They've been cash flow positive every year, even in those 2 years where they posted a net loss. They were net income positive. So you can see net income was negative 300,000, but they had positive cash flow. And you can see that all these years cash flow has been increasing nice over the last couple of years. Not exactly as steady as I'd like, but it's been growing, and you can see the trend overall. But there are some more peaks and valleys than I typically like to see. But still a fan of this cash flow growth, and you can see that it's gone up to 2.1 million this year from operating activities. CapEx, you can see CapEx is kind of strange here. It kind of goes in fits and starts. So you can see they had 900,000 in 2003, and then none for the next 2 years, or hardly any in the next 2 years. And then they spent 2 years where they spent 800,000, another 600,000. Then it goes back down to zero again, or near zero for the next 2 years. So, and then it's back up to 1 million and 1.4 million over the last 2 periods. So it's kind of weird how their CapEx goes. And maybe this is due to them being such a small company that big companies kind of smooth out their CapEx over all their different enterprises and all their various businesses. But a small company, when you're so concentrated, your CapEx may go in fits and starts. But I thought this was interesting to see how their CapEx goes way up in a couple years and then way down in other years. And this is mainly due to the nature of what they're buying with their CapEx. They buy this cobalt-60, which is the radioactive material that they irradiate the food with, and it decays. So from high school physics, it'll decay, and it'll decay into a more stable form. As it decays into a more stable form, it's going to be less effective at irradiating the food, so they have to go out and replace it as it becomes more and more stable. So you can see every couple years they have to go out and replace it. And according to the 10K, which we can go to here, so that's the 10Q. Let's go to 10K. It'll give you the rate in here, and it's about 1% per month that it decays. And as you can see, I can go through the whole 10K here pretty quickly because it's not that big a company. So they use cobalt-60 source. Here it is. Their level of radioactive energy of cobalt-60 declines at approximately 1% per month. So this is another thing you can look at it, and looking at these little companies, these 10Ks, you can get a good idea of what's going on there a lot easier. So you can see 1% a month, their radioactive material, their cobalt-60 is going to be less effective, so they have to go out and replace it. So this is a big chunk of what's in their CapEx. In addition to this, we also find, again in the 10K, is that they went out and spent a lot of money on this new tech, or upgrading their technology, upgrading their equipment. So we're going to go back down here to their cash flow statement, which is nice here that they can tell us all about what they're doing. You can see here they had purchase of cobalt. There's 900,000 that they spent on cobalt this year. Then they had some purchase of equipment and some building renovations. So they were going out and renovating their warehouse and their facilities and modernizing a little bit. If you also go to the 10Q, which gives us a little more detail on the more current stuff, we could see another interesting aspect here. This certificate of deposit. So of that 1.4 million that we see here that they spent in the last 12 months, 150,000 of that was for the certificate of deposit. And if you go through the 10Q, you can see this was for bonding for their radioactive license to make sure that they have adequate liability coverage for being in the business they're in. So this was a one-time payment. We shouldn't see this again. They shouldn't have to pay this every year. So when we do our cash flow analysis, we're going to have to take this out in our future cash flows because this is kind of a one-time deal. And if they do have to increase that number, it's going to be in proportion to their revenue, which is obviously a good thing that they're going to be growing in the business. You can see again, here's that 900,000 they spent the year before. They spent almost another 900,000 in cobalt again this year, getting it in. Again, those fits and starts. There's 2 years here of them powering up their facilities and getting all this cobalt ready for additional customers and replacing the old cobalt-60. But here's something else. This is this equipment deposit. So 400,000 or almost 400,000 of their CapEx is going to this equipment deposit. which is a rather large number in proportion to their total capex. So we went through and looked at this, and if you look at, I believe it's at the very end. Sorry, I have to find this page. I think it was in the 10K. Yes, it was at the very end of the 10K. Page F18, so again, not very big. On March 12th, the company entered into an agreement to replace the programmable logic control PLC system. I had no idea what that was, so I went out and looked at it. For an estimated cost of $800,000. And this is the last part of a multi-year project intended to maintain the facility in good and reliable condition. So they spent some capex out there upgrading their equipment, and the PLC is it's kind of like the brains of the equipment to make sure that everything's running smoothly and everything is operating okay. It kind of makes sure everything's in order. It's the brains of the system, and it cost them $800,000. So what that means is that they have paid $393,000 of that. So they're due another $400,000 to their provider for this equipment. So we have a massive capex here, relatively speaking, that's going to be coming due, an additional $400,000 coming due probably in the next quarter. So we probably see that in the annual report when that comes out in the next couple weeks or so, that they're going to have another $400,000 on their books for that. Again, this is really going to be a one-time thing. You can see that they haven't really spent money before at that level on equipment. So I think we can assume that the capex they're spending on this PLC system is going to be really a one-time thing for us as well. So I really want to take that out of my future cash flows, because it's not really going to be a capex that we're going to have in the future. You can see here they're spending the $800,000 in here, and there's some other little things in there. It looks like this is mostly tied to their cobalt. If you saw their cobalt was $800,000, $900,000, you could see here maybe this was $700,000, and this was some more cobalt at $600,000. So their capex is really consumed by this cobalt number, and that's really what we're going to have left over as trying to smooth out our capex. The long-term bond and these upgrades in the warehouse, they're saying it's on the last leg, so we shouldn't see too much of this anymore. And really, we should only see this if they really start expanding into a new plant or something like that, or increasing the size of the plant. So we take a look at free cash flow. In the end, how's it gone? It's gone from zero, 300, 400,000. A couple losses here. Okay, sorry about that. So we had a little loss here in 2006 and 2007, but you can see that it's kind of grown out of that, and most of this loss comes from that spending of that capex. So we've got a free cash flow here of this 700,000, this 900,000, 700,000 here. So it looks to be a pretty normal, stable. It's not really a stable cash flow as much as we'd like to see, as we did with Bed Bath & Beyond and Oracle. But it is positive, and it does seem to be going in the right direction here. And given their growth, their revenue growth, we should see free cash flow growing over time, especially now that they're getting through this large capital expenditure for upgrading their facilities, and they've purchased some large amounts of Cobalt 60 for the next couple years. So this free cash flow number should increase over the next couple years, and then we'll see it drop a little bit when they buy more cobalt, but we shouldn't see that facility investment much in the near future, or probably in our foreseeable future. So I'm going to discount that out whenever we go to do our discounted cash flow valuation, which we can get to right now. So if you go into the discounted cash flow valuation sheet, you can see that it automatically populates with a 12% growth rate, 12% discount rate, and that's for free cash flow. When we look at free cash flow, however, we get 700,000, but again, what we said was there was some capex in here that we're probably never going to see again, and there's some that we won't see for the next couple years as well.